Mortgage affordability is the measure of how much you can afford to borrow for a mortgage. Lenders assess your affordability in order to determine how much money is safe for them to lend to you, based on your earnings, outgoings, and history with borrowing. There are a few important variables which lenders assess in order to calculate how much money you can borrow. While the variables assessed tend to be similar lender to lender, each provider will use their own calculation. So what you can afford with one lender might be significantly different to what you can borrow from another. To add an extra layer, lenders will tend to change their calculation in response to market changes. As an example, we saw lenders tightening affordability criteria in response to the cost of living crisis and increased energy prices. It's always beneficial to seek expert advice from a mortgage advisor. They'll have a good understanding of lender criteria and affordability, plus they can help you navigate a changing market. For now, let's run through the key variables that impact your affordability. Income multiples are used by lenders to work out the maximum mortgage that they can offer you. The lender will ask to see your recent payslips, or if you have self-employed income, your SA 302s. Typically, lenders will offer you a mortgage that's between 4 to 4.5 times your eligible income, although some people may be eligible for increased borrowing based on their income or profession. Equally, if you deem to be more risky, some lenders will reduce their income multiples. If you are buying with someone else, the multiple will be based on your combined household income. It's worth noting that not all income is equal in lenders' eyes. If your income isn't declared, lenders won't include it. Similarly, with bonuses and commissions that aren't guaranteed, most lenders will take a percentage of earnings, and they'll need to see evidence that the additional earnings have been consistent. Some lenders might also have tighter restrictions if you run your own business or are self-employed. The lender will ask to see your latest bank statements so they can see how much you spend each month and on what. First, they'll assess your total debts, so that would be any insurance, loans, or credit card repayments. In mortgage land, the comparison between your debts and income is known as your debt to income ratio, or DTI. To assess the best deals, most lenders will be looking for a DTI ratio of between 20 and 30%. Next, they'll look at your fixed outgoings. These will be costs you have for direct debits, things like your gym membership, your Netflix account, or your mobile phone contract. Lenders will need to be sure that if mortgage rates increase, you will still be able to afford your mortgage. This process is called a stress testing. It aims to ensure that borrowers never take out a loan that they are unable to pay back, and was introduced after the 2008 financial crisis. While it may seem annoying, this is actually a vital part of safe and ethical lending. After your outgoings, the leftover money you have each month must be enough to cover your mortgage repayments if interest rates rise by a specific amount. If you are finding that your affordability isn't enough to get the mortgage you need, talk to Tembo. We specialise in helping buyers boost their affordability so they can increase their borrowing power and make home happen. Head over to tembomoney.com to get started.